Hello and welcome to another APW Partners quarterly market update. I'm joined once again by Dr. Steve Garth, who is a consultant with the APW Partners Investment Committee. Good morning, welcome Steve.
Yes, hello Jeff, thanks for having me.
Steve, I think the last time we met, we were talking about the escalation in the tariffs and trade wars. And of course, we're now on the cusp of the so-called Liberation Day. I'm not sure about the name there. It almost feels like the battle is only just beginning. Obviously, a heightened level of uncertainty. For businesses, for consumers, and for investors. Steve, let's perhaps begin with the US market, the epicenter of what's going on in the world at the moment.
Yeah, look, it really is. In a way, Jeff, you're absolutely right. The quarter's dominated by Trump, tariffs and trade wars, and it really has made for a tumultuous start to the quarter. And while it's made markets uncertain around the world, it's a bit of an own goal when it comes to the US, because that's the market where consumer sentiment has really been knocked around. Economy is slowing, and you can see that in the returns. Now, in the chart we got here, Jeff, normally we would show just the S&P 500, which is the big index that you hear about for the US. But the S&P 500 is really made up of companies on two different exchanges. One exchange is called the NASDAQ, and that's where the high technology stocks live. And the other exchange is the good old New York Stock Exchange, and that's where the older industrial companies reside. So that's about 50-50 of the S&P 500. And you can see on the chart here that the NYSE, it's done okay over the quarter. It's up, 2%. But you can see that the NASDAQ is down by 10%. So those tech stocks have been hit the hardest. Overall, S&P 500, it's down positive over the year, and it had a very strong 2024. But it's down around about 5% for the quarter.
Those tech stocks were certainly priced for perfection. And you remind me, I think last time DeepSeek had just hit the headlines.
When we recorded last time, DeepSeek had just hit the headlines. And so if you ask why the NASDAQ is down more than the New York Stock Exchange, it's actually got to do with DeepSeek and the stock called NVIDIA. So NVIDIA is the largest, or it's in the top three largest stocks on the NASDAQ, which is also the top three largest stocks on the S&P 500. Now, NVIDIA, as we've talked about before, Jeff, it's a stock that no one had really heard about a couple of years ago, but they make the AI chips. And in February, the Chinese released a competitor product, which was cheaper, faster, more efficient. And suddenly everyone who had been piling into AI-related stocks going, this is the future, suddenly thought, oh, maybe we're being a bit over-enthusiastic with our valuations on companies like NVIDIA. So despite the fact there's a general market downturn, you can certainly see the effect of DeepSeek on NVIDIA's share price there. So NVIDIA is down by 20% for the quarter. So that's what's really knocked down the NASDAQ and a large contributor to knocking down the whole of the US market.
And it's interesting too, I think we've seen some capital flight away from the US over the quarter and perhaps even over the back end of 2024.
Yeah, that's absolutely right. Mind you, some of that capital's gone into gold as well for a fear of what's going on in the US. But to your point, Jeff, when you look at how other markets around the world have gone, now we know that the developed market index, which we're showing on the left-hand side here, that's negative mainly because the US make up 70% of that particular index. So that's bringing that down. Australia, I've got there, we know that's a negative number, but Australia's a very small part of the world market.
2 or 3%.
2 or 3%. So that doesn't really contribute. But another big market is Europe, and you can see that Europe are up by 10%.
It's quite significant.
In the quarter. And overseas, China's actually doing quite well. And so you can see the emerging markets also with a positive quarter and a positive year for that matter. So that chart really speaks to the value of diversification across other markets outside of our own and outside of just the US as well.
Yes, indeed. It's seeing the turmoil, as you say, in the world. It reminds me of the reference to the fog of war, which is a Napoleonic term, describing the the chaos and the disruption and the catastrophe that occurs on the battlefield when hostilities are at their most substantial. The challenge for investors in this sort of environment with uncertainty and volatility at such elevated levels is to really to remain focused, to retain a sense of perspective, as you say, be well diversified, and make sure they've got a robust process for making good quality investment decisions.
Yeah, that's all absolutely right, Jeff.
Mm.
And in fact, that sort of leads me to have a quick look at the Australian market, because it plays into the points you've just made. You can see there's a fair bit of uncertainty playing into the Australian market. Now, it's not actually all got to do with tariffs. Tariffs, believe it or not, will have a relatively small effect on the Australian market
Directly, yeah.
and the Australian economy. But it creates global uncertainty, and that's certainly pushing down the Australian market in a period where our economy is running at a very slow pace, a very slow pace, probably the slowest in decades.
It's a
So
concern.
that's pushing down the Australian market.
So, Steve, a topic we haven't talked about for a while, which can be a bit confusing, economic jargon, the concept of stagflation.
Yeah. So stagflation would imply that inflation is going up, but growth is going down, and that's a really bad combination.
Mm.
So this is where central banks get really nervous, because if inflation's going up, you'd normally push up interest rates because that will curb inflation, and
Yeah.
you've certainly seen that last few years.
Mm-hmm.
But a slowing economy would mean you need to cut rates in order to get growth going. So
And there's a suggestion that Trump's tariff policy will slow economic growth, not only in the US, but also globally.
that's absolutely right. And so probably aware that just yesterday the RBA kept rates on hold.
Mm-hmm.
The week before, the US Federal Reserve kept rates on hold. Central banks are just looking to see how all this will play out.
I think in conclusion, Steve, we can say we're not out of the woods yet. There's going to be some further second and third order effects and probably some negotiation around tariffs and so forth. The geopolitics hasn't gone away in Ukraine, Middle East, Taiwan. So lots for investors to consider. But I think on balance, I think if an investor comes away at the March quarter with a sort of a break-even position, we'd always like to see it a little bit higher, but I think that's probably a good indication that they're well diversified, well positioned for whatever the future may hold.
That's right, Jeff. And of course, the audience would have noticed we've always had the 2024 returns up on screen as well. It's always a good thing to keep in mind that when the quarter's not so good, take a slightly longer look and go, actually, I'm doing pretty well here.
Indeed. Steve, thanks once again for the information you've provided today, and most importantly, the insights for the viewer and for our clients and investors. And to you, the viewer, thank you very much for your time, and we will see you very, very soon on the next quarterly market update. Bye for now.